The ongoing banking crisis in the United States has become a topic of great concern, attracting the attention of economists, policymakers, and investors alike. Warren Buffett, a renowned investor and CEO of Berkshire Hathaway, recently shared his valuable insights on the matter during the Berkshire Hathaway annual shareholder meeting. Joined by Charlie Munger, an American businessman, investor, and philanthropist, best known for being the vice chairman of Berkshire Hathaway, and Warren Buffett's closest partner and right-hand man, both addressed a wide range of questions from Berkshire Hathaway shareholders, shedding light on the implications of the crisis for the U.S. economy and its potential impact on the anticipated 2023 recession. Join us as we explore the banking industry's challenges and the significance of Buffett's observations in navigating this complex financial landscape. Hello and welcome back to another video on our channel, Finance Sense, covering all the latest trends in the financial markets and the economy. But before we begin, make sure to like, subscribe, and click on the notification bell to stay updated with our videos. Without further ado, let's head on to the video. During the Berkshire Hathaway annual shareholder meeting, Warren Buffett was asked about the potential economic consequences if Silicon Valley Bank's deposit had not been fully covered. He responded by stating that it would have been catastrophic. He emphasized the necessity of providing coverage and highlighted that although the FDIC limit is set at $250,000 by statute, the United States would not behave in a way that adheres strictly to this limit. He drew a parallel to the country's commitment to avoiding turmoil caused by the debt ceiling issue, indicating a proactive approach to protecting the economy. Buffett's remarks were in response to the failure of not just Silicon Valley Bank, but also Signature Bank, First Republic, Silvergate, and Credit Suisse abroad. It also reignited the discussion of how much more the Federal Reserve should do to help beyond the current $250,000 federal insurance on bank accounts. The FDIC, the Treasury, and the Federal Reserve bypassed this limit earlier this year by declaring a systemic risk exemption for both Silicon Valley Bank and Signature and proclaiming that all deposits would be insured. Although it was an unusual action, it has come under fire because of the heightened moral hazard risk for banks. Others, however, contend that the government's action was unavoidable since it guaranteed the general public that their bank deposits would be secure, lowering the possibility of more bank runs. And Buffett believed this action was inevitable and necessary to convey the right message to the American people. Buffett further expressed his disbelief during the forum, contemplating the reaction of individuals in the administration, Congress, Federal Reserve, and FDIC if they were faced with explaining to the American public why the insurance coverage for bank deposits was limited to only $250,000. He couldn't fathom anyone willingly stepping forward to justify such a decision that could potentially ignite chaos by triggering bank runs across the nation and disrupting the global financial system. In Buffett's view, given the circumstances, it was inevitable that steps would be taken to prevent such a scenario from unfolding. Interestingly, the worry hasn't really subsided despite the U.S. Treasury and the Federal Reserve stepping up and taking significant steps to preserve the financial sector. It continues to make headlines, is still a hot topic of conversation, and continues to put many people on edge. So what is Buffett's general view of the banking industry? Buffett stated that the nature of the industry has remained relatively consistent over time. He acknowledged that fear has always been pervasive in banking, with its contagious nature affecting people's sentiments. Reflecting on historical events, Buffett mentioned that there were instances when fear was justified, while in other cases it proved unwarranted. Drawing from personal experience, he shared an anecdote about his father losing his job during a bank run in 1931. Buffett further explained that, in the past, observing a line of people outside a bank would prompt individuals to join the queue as a precautionary measure. This helped provide the system some buffer time without their knowledge at the time. Bankers were given time to try to calm the issue and maybe come up with a solution while waiting in line to receive money. However, that was back then, and things aren't the same now. Buffett then remarked that the notion of deposits being secure and immovable in the present time is outdated. He noted that people who believe deposits are still sticky are living in a different era. Buffett highlighted the convenience of modern technology, emphasizing that with the simple press of a button, individuals can swiftly access their funds without the need to physically wait in long lines at banks. He contrasted this to the past, where waiting in line was common, with tellers meticulously counting money in gold to alleviate the waiting customers' concerns. Buffett emphasized that nowadays, a bank run can occur within seconds due to the ease and speed of digital transactions. And that's precisely what happened with the collapsed banks. Over $40 billion was taken out of Silicon Valley Bank in a single day out of a total of $173 billion deposits. These days, bank runs can be shorter and more severe than in the past, raising the possibility that a single bank run will grow into a panic-driven crisis that moves quickly. And this is why the FDIC, an insurance institution sponsored by all the banks to protect the first $250,000 of depositors' money, is so crucial. In the event that a bank run attitude spreads across the financial system, it won't spiral out of control. People will be aware that for the most part, their money is completely secure. Buffett highlighted the importance of maintaining confidence in the banking system and ensuring the economy's stability. He pointed out that if people become anxious about the safety of their money and start withdrawing their funds abruptly, it would negatively impact the overall functioning of the economy. Buffett acknowledged the logical reasoning behind the existence of the FDIC. He noted that although the FDIC has undergone some changes over the years, it has successfully provided full coverage and ensured that depositors receive the entirety of their funds. Despite these measures, Buffett expressed his concern that there are still individuals who remain worried, emphasizing that such apprehension should not persist given the comprehensive protections in place. And although it shouldn't, it has happened. Even though the FDIC is operating normally, the Treasury and the Fed have intervened and fully backed up the banks, and many Americans are nevertheless highly concerned about the security of their country's financial system. In addition, Buffett criticized the inadequate communication surrounding the banking industry and its related issues. He attributed the poor messaging to politicians, agencies, and the press, suggesting that their vested interests may contribute to the lack of clarity. Buffett highlighted the misunderstanding among many individuals regarding certain assets, such as the debt ceiling and the $250,000 limit on FDIC coverage. He emphasized that despite these limitations, the FDIC, the U.S. government, and the American public do not want banks to fail or depositors to lose their funds. Buffett soon accuses the media and bad-acting politicians of basically fomenting fear, which has eventually caused the situation to escalate into something it really shouldn't have been. But, as Warren notes, that's the world we live in. Even a small spark can lead to a significant crisis or fizzle out unexpectedly, making the outcome uncertain. However, Buffett expressed his lack of concern, stating that he keeps his funds primarily in cash and treasury bills at Berkshire Hathaway. He disclosed that Berkshire holds a substantial amount, around $128 billion or a similar figure, to ensure they are prepared in case the banking system encounters temporary disruptions. While Buffett did not anticipate such a situation, he acknowledged that it remains a possibility. Buffett also takes the time to emphasize that this isn't the primary problem that initially caused the crisis, even though the media and fear-mongering politicians have recently heightened the concern around the banks. As is typical in the banking industry, management teams at a small number of institutions have taken excessive risks, which is the root cause of the problem. For instance, in the case of Silicon Valley Bank, the initial worry was caused by extensive management oversight intended to reduce their interest rate risk. They planned to keep the several government bonds they purchased at low interest rates until they matured. But the value of such bonds decreased when interest rates increased. Additionally, as soon as investors began to withdraw their funds, the bank was forced to sell off those bonds at a loss, which only made the problem worse. As more depositors became concerned that the bank was losing money, they started looking to withdraw their money, which finally caused the bank to fail. Ultimately, the bank's management team took unwarranted risks to increase revenue when they could have easily prevented this. The absurd thing is that while the sky is falling in banking, the executive team often suffers no consequences. Additionally, Buffett expressed his concern regarding the flawed incentives in bank regulation and the lack of proper addressing of the issue. He emphasized the need for accountability and punishment for those responsible for wrongdoings in banks, specifically holding CEOs accountable for their actions. In his view, both the CEO and directors should face consequences if their actions lead to the bank's failure. Buffett believed that future stockholders should not suffer for the mistakes of others, as they bear no responsibility for the bank's troubles. He criticized the current system for failing to impart valuable lessons and allowing those individuals to maintain their wealth, social standing, and involvement in charitable events without repercussions. Buffett considered this an unfavorable lesson, especially when the actions of these individuals impact the overall economy. While he acknowledged the existence of work to be done, Buffett believed that addressing this issue was not an insurmountable task. He attributed the problem to a flawed response and ineffective communication surrounding the matter. And this is one of the reasons why Buffett recently sold off a substantial amount of his bank stock holdings. But Buffett went on to say at the conference that another important factor in his decision to sell was the fact that he now just doesn't think bank stock performance can be predicted with any degree of accuracy. Buffett then revealed that his company Berkshire Hathaway has been actively selling bank stocks recently. This decision was initiated when the COVID-19 pandemic emerged and other sales were conducted over the past 6 months. Buffett acknowledged the uncertainty surrounding shareholders' future in major and regional banks, as well as the overall ownership of banks. He emphasized that events and external factors would play a significant role in shaping the future of these institutions. Buffett expressed concerns about the involvement of politicians and the general lack of understanding about how the banking system operates among many individuals. He pointed out that the communication between various parties involved in the financial system and the American public has been less than perfect, leading to confusion among the public regarding banking matters. This confusion can have significant consequences, particularly regarding the stability of deposits. Buffett highlighted that deposit dynamics have undergone changes in the past, such as during the 2008 financial crisis, and the current situation has the potential to bring further alterations that could impact various aspects of banking. Given the circumstances, Buffett emphasized his company's cautious approach toward bank ownership in such uncertain times. Naturally, this brings up Buffett's first investment rule to avoid losing money. You shouldn't acquire stocks if you can't confidently project the company's trajectory over the next decade. It turns into a gamble. Buffett currently believes that buying bank stocks is typically too risky as a result of politicians inciting panic, their ignorance, and the illogical behavior of people in general. It sounds like we've reached the end of this video. If you found this video helpful, please hit like and subscribe, and comment down below your thoughts in the comments section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you next time!